Okay. File in here. Good morning and welcome to the Shenkman Private Client Group Accountant Attorney Spring Webinar Series. This program is entitled U.S. Estate and Gift Planning for Foreign Parents with U.S. Children. For those who don't know me, my name is Jonathan Shenkman. I'm a financial advisor, portfolio manager, and an accredited investment fiduciary at Oppenheimer based in New York City. The goal of all my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 20-25 events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, CNBC, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. My latest article was published in Kiplinger and is entitled 5 Ways to Make Sane Investments When Everyone Else is Crazy. After the program, I'll send out a link to this article and all the publications where I publish my work. Today, we're privileged to hear from Stanley Ruchelman and Galia Antebi, both attorneys at Ruchelman PLLC based in New York. Stanley focuses on sophisticated corporate restructuring, individual tax, and multinational compliance matters. He has decades of experience working across industry and borders. This has included advising a non-U.S. shipping client under IRS examination, a major company importing broadcast equipment to cover the Olympic Games, and many other complex and nuanced international tax situations. Galia focuses on offering tailored cross-border tax planning to individuals and owner-managed businesses. She works with her clients to navigate the complex web of international tax provisions to accomplish their strategic goals. Her practice includes planning for cross-border real estate projects, planning for mobility of individual clients, and restructuring relating to U.S.-owned foreign businesses as a result of the 2017 tax reform. She also advises foreign families with U.S. members on tax planning for the next generation, including through the use of trusts. Today, Stanley and Galia will be speaking on U.S. estate and gift planning for foreign parents with U.S. children. And with that introduction, I'll now turn the program over to Stanley and Galia.
Thank you very much, Jonathan. Well, we're going to divide this program into 2 portions. The first portion will be the 10 most important rules to remember when advising European clients with U.S. assets or children. And that's the boring part. The next part, which Galia will handle, is how you apply these rules in various fact patterns. So let's begin with the rules. Rule number 1. In the U.S., gift or estate tax is imposed on the donor or the donor's estate. It's generally not imposed on the recipient of the property, except in limited circumstances that we won't get into today. However, this is just the opposite from the process in most of Europe. In Europe, both lifetime gifts and gifts at death are subject to inheritance tax, and inheritance tax is imposed on the recipient, not on the donor. Now, this tends to be very important for Europeans because the tax is lower, the inheritance tax is lower when the recipient is a close blood relative, principally children. If it's given to a stranger, the tax rates are high. So we frequently get questions when we do planning as to whether it makes a difference if the children get it or don't get it. Now, in Europe, one thing to remember is that a trust for the sole benefit of a settler's children is not a close blood relative. And so the gift tax rate is very high, and trusts in many jurisdictions are not viewed to be a valid tax planning opportunity. Now, although the tax is imposed on the donor, there is a financial risk for the donee, and that is gifts in excess of $100,000 from a foreign donor are subject to reporting on Form 3520. It's a very simple form. It has 3 boxes that you fill in, plus your name and address and whatnot. But if you don't fill in those 3 boxes, the penalty that can be imposed is up to 25% of the amount that was received and should have been reported. And the penalty is very actively monitored now and imposed by the IRS. and at times without even looking at reasonable cost statements that are attached to a late 3520. Rule number 2, for a non-resident, non-citizen individual, U.S. estate tax is imposed only on U.S. situs assets owned at death or given away during lifetime, but subject to certain retained powers or interests by the non-resident decedent. So U.S. situs assets are very clear. If it's in the U.S., it's a U.S. asset. It could be jewelry in the U.S., it could be your automobile, it could be shares of stock of a U.S. corporation. It could be a debt instrument of a U.S. corporation. However, there are specific carve-outs for certain property that is U.S. situs property, but not subject to estate tax. One would be bank accounts, as the policy is to encourage foreign investment in U.S. financial institutions. Also, items of publicly traded bonds, items of portfolio debt, which is a technical term defined in Code Section 871H that allows interest to be paid without withholding tax when the payee is a foreign person. Those are also carved out of estate tax. Rule number 3, for a non-resident, non-citizen individual, U.S. gift tax is imposed only on gifts of U.S. situs tangible personal property and real property. What's missing is intangible property. So you can give away shares of stock, you may be able to give away partnership interests, you can give away bonds without any gift tax being imposed, because these are all items of intangible property. Intangible property is a contract right, you typically embodied in an instrument that gives the holder certain rights, but the value isn't in the paper that it's written on, the value is in the right against the counterparty. Now, there are many interesting examples of problems in determining either the situs of income, the situs of the asset, or whether the asset is intangible property. Just to give an example, for income tax purposes, shares of stock in a cooperative and the proprietary lease would be viewed to be a U.S. real property interest, so that when you sell it, there's FERPTA gain if you're non-resident, non-citizen. However, it's still intangible property. So rather than a sale, it can be given away without the imposition of gift tax. And also, it's a non-recognition transaction, so there's no taxable income. A wire transfer, most people believe that a wire transfer is intangible property because you can't really touch it, see it, feel it. One day, your bank account has $10 in it. The next day, your bank account has $250,000 in it. So the question is, if the wire transfer is simply a bookkeeping entry at two different banks, why is that a problem? Why is that potentially subject to estate or gift tax, gift tax in particular? Well, advisors have two views on this. One view is that in the 1970s, the IRS equated a wire transfer or a transfer by check as the equivalent of taking a wheelbarrow filled with $250,000 bills into the bank and giving it to the bank. That might have been the case. Very few of us, I'm sure, on the session remember the 1970s. And maybe that was the case in the 1970s, but it's not the case now. Another potential question, two other potential questions are the situs of partnership interest and the situs of a single member LLC. For the LLC, do you look at the assets owned by the LLC or do you look at the LLC interest? And interestingly enough, there's a lot of wiggle room in this area. And there are at least two cases that say you look at the single member interest, the LLC interest, at least for evaluation purposes. And as for the partnership interest, the most recent IRS guidance was a 1955 ruling in which the IRS said, you don't look to the place of formation. You don't look to where the assets are. You look to where the entity does business, and that's the the situs of the partnership interest. Rule number 4, in computing the tax base for estate tax purposes of a non-resident, non-citizen individual, 2 steps are involved. First, you have to determine the fair market value of the U.S. situs assets. And second, you have to determine, at least for estate tax purposes, whether claims against the estate and administration costs can offset the tax base in computing U.S. estate tax. Well, the answer is yes, the fair market value is easy. And as to the allocation of expenses and claims, yes, you're entitled to deduct the claims, but not in a straightforward way. The policy is that, that every dollar that's in the estate of the non-resident decedent stands to support every claim and every expense. Therefore, you can't direct trace expenses to particular assets. You need to, number 1, file a true and accurate tax return, estate tax return. You must fill in, you must identify the global assets, their value. You must determine how much of those assets are in the US and out of the US, and also global expenses. You take the pot of global expenses and you apportion to assets in the US and assets overseas based on relative values. So I've been using the term non-resident, non-citizen individual in determining whether, and the alternative is, when is a person a resident? And the answer is that the rule is the old rule that's pre-1984, I believe, that looks to domicile, which is living in a place with an intent to make it your home. The objective rules that are found in the 877, in the 301 rules, the 7701 B rules, just have no application. And so what you have to do is look to see where the person calls home. That is the person's domicile. The next rule to remember is that there are special rules for that exist for with regard to computing gift tax once you know that an asset is taxable. The first thing is that when a non-resident, when a non-citizen, whether resident or not, gives an asset to a citizen wife, the unlimited marital deduction applies. When the citizen spouse gives the same gift to a non-citizen spouse, be it a husband or a wife, there's no unlimited marital deduction allowed. There's the $15,000 annual exclusion, but there's no unlimited marital deduction. Instead, the $15,000 annual exclusion is increased to $157,000, which goes up. It's a number that goes up every year. The next item, the next rule is that there are special rules for estate tax purposes. And in estate tax purpose, again, if the non-citizen spouse dies, leaving everything to the surviving spouse, there's an unlimited marital deduction. But when it's reversed, so that the non-citizen spouse is the surviving spouse, there's no unlimited marital deduction. Instead, there's something called a Q-Dot trust, which is a tool, which is a trust that's set up solely for the benefit of the spouse and is used to defer the estate tax exposure until there's a triggering event, which usually is the trust doesn't qualify anymore, or 2, there's been a mandatory distribution or the death of the surviving spouse. There are also special rules for interspousal transfers during life, and I believe that we've spoken about them. And we need to know the lifetime exemption is $11,700,000 currently. But if you're a non-resident, non-citizen, the lifetime exemption is $60,000, and there is no is $60,000. And as I mentioned, it becomes problematic. There are two more rules that I'd like to just speak about quickly. One rule is that there's a GST tax exposure, but GST tax exposure for non-resident, non-citizen only kicks in if there's a state or gift tax imposed on the asset transfer. And finally, there are 14 estate tax treaties and one income tax treaty that deals with estate tax matters. Some of the estate tax treaties also apply to gift tax, but not all of them. The most important benefit of a treaty tends to be extending the unified credit that exists for a citizen to the resident of the treaty partner jurisdiction, so that the $11,700,000 can be claimed as a benefit, but only on a pro rata basis based on the situs of the person's assets. And with that, we'll move to Galia and some examples.
Okay, thank you. So we will jump to some of our illustrations just to make it more visualized as we talk about planning techniques. But when we do talk about that, it's important to remember that when you do planning, there is hardly ever a plan that's perfect for anyone. And each plan has some balancing act that has to happen. We have to ask the client what the goals are and then try to balance them, because some clients, and Stanley mentioned, there are some estate tax treaties. So some clients can have that proportional share, some cannot. Some have foreign estate tax, so they're going to have a credit of the foreign estate, so they don't mind paying here because they'll have a foreign tax credit anyway. So we have to really balance all the goals for the specific client in order to come to the best plan. The other thing to remember is income tax consequences. Stanley mentioned earlier certain transactions that can be tax-free. Not all of them. We have FIRPTA, which are the rules that govern non-residents ownership of U.S. real property, as an example of an asset, U.S. situs assets that many foreigners do own. And when you transfer that interest into something that the receipt of will not be subject to US tax when it's disposed of, then the actual transfer cannot enjoy the non-recognition available otherwise and triggers tax. So we have to remember about that. We also have to remember that if we have children that are US residents and more than temporarily, right? If it's something that someone is here for a few years, you don't necessarily have to think about their estate tax or their issues for income tax. But you certainly want to consider those things when that person is here for good, because if they inherit a structure that may not work well for income tax, won't be efficient during the life of the asset in their hands, then maybe it wasn't a good plan. So those things are to be kept in mind. And here we see the first sort of the base case, right? Someone comes and without advice or with advice, but just doesn't care because they think that they're too young to care about death. They own real property directly. And there are some good things to it, right? It's simple. They don't have to worry about respecting a structure, which is something that is important, because if we have a perfect structure that takes away the exposure for estate tax, and maybe even works for income tax, and it's all great, but no one respects it and they treat this structure as their own alter ego, there is a good chance that the IRS will do the same and treat it as your alter ego, therefore exposing you back to the estate exposure, because you now are viewed to own directly the property. So in this structure, they don't have to worry about it. They know their exposure. Maybe they take lifetime insurance to cover that exposure. Maybe they think that they're simply young enough and they'll sell it before. And I have a story about a couple that I actually only met the wife after the husband died. They were in their 40s. They bought 2 apartments in Brooklyn. And when the husband was diagnosed with cancer, they spoke to a New York lawyer, not me, who advised to transfer it to an LLC. And that was supposed to be the solution. At least that was what the client understood. And I don't know if it was part of a sort of 2-step transaction that the other lawyer was planning, because as Stanley mentioned, you can gift an interest in an LLC as an intangible, as opposed to being able to gift the property, real property in the US. So maybe it was meant to be a transaction that has two steps, and maybe they were not afraid of the step transaction, meaning the IRS ignoring those two steps. But in any event, he did die before he was able to gift the wife or the younger children the LLC interest. And so she heard from someone that it's still subject to tax. She called me to ask if it's true, and unfortunately, I had to say it is true. And an LLC interest, however, it is free of gift tax, is still subject to estate tax. What if we try to do something like this step transaction that we talked about with transferring it to an LLC and then gifting it to your spouse? What about giving maybe a gift of funds to a child or wife, what have you, someone young enough to, again, not worry about estate tax? That too, same issue. Is it a two transactions separate, or should be viewed as one transaction, is the question that has to be asked. Because if we are trying to look at day two, sort of what are you out of pocket? If the father gave a gift of cash and then the cash came back to him, but he then sold the property, yes, he was supposedly only subject to income tax on the gain, but really, what is he out of pocket? We have a risk of two steps being stepped together and viewed as a gift tax to the son, which will also mean one of the other rules to remember is the step up in the value at death. When someone inherits property, they inherit the property with a basis of fair market value. So if we gave someone a gift, that doesn't apply. That rule is only at inheritance. So if we have a gift here, because that is the way that the IRS may treat it, then the son gets a carryover basis, doesn't get the fair market value at the time of death. If it was viewed to be an inheritance, we would have a fair market value basis, which means that in this scenario, if we were stepped together, we are worse off. So, because we still have the gift tax amount, which is similar to the estate, and yet we don't have the step up in the basis. Introducing debt is an interesting way of reducing the value, because we are then supposedly looking at the net value of the net equity in the property. But we have to remember to distinguish between non-recourse debt that actually gets you to, as a non-resident, non-citizen, to reduce the full amount of the loan and only look at the net equity. But if we have recourse debt, we don't get to do that. And while we can disclose sort of the inventory that we have worldwide, this may help you get a portion of the debt recognized, but the problem with that is that it's not only the privacy, that most people don't want to do that, also the issue of, is it worth it? Is it worth disclosing? Because you're only going to get a portion. If you have most of your assets outside the US, it might be that your portion is sort of small, and then it wasn't even worth giving all the disclosure, the work that is involved, plus simply losing your confidentiality. This is the non-recourse. Now, if we interpose an entity with the debt, that is different, because now it's a valuation question. It's no longer a question of recourse or non-recourse. We have to value the asset held at death. And the asset held at death would not be the property with the loan on the property, but would be shares in the corporation. And while they're still subject to estate tax, because it's US situs assets, it's a US corporation, we are expecting the value to be lower, and therefore the estate exposure lower. But estate exposure still exists because, again, it's US situs. So some clients can come, someone can mute. Clients can come and say, so, I don't want that exposure at all. How about transferring the stock of the US corporation to a foreign corporation? And that is a nice idea, but we do have some problems with that. And the first problem that people think about is normally FIRPTA, because as I mentioned earlier, when you transfer an asset, a real property asset, into an entity that will not be subject to US income tax, to FIRPTA, at the sale of the interest of the foreign corporation, then it cannot be a non-recognition provision under FIRPTA. So we all know that we have a FIRPTA problem. The thing that people don't think necessarily about is the fact that we may have inversion here. And I say may because there is a 2006 notice that didn't treat it as an inversion, but there wasn't really any legal reason for that. When we have a US corporation and we look at the inversion provisions, and directly or indirectly, a foreign company buys substantially all of the assets of the US corporation, that's by definition an inversion. And when we have a certain amount of ownership of all shareholders in the new company, in the new foreign company, then we have the next step of an inversion, not only triggering gain, but also having the foreign corporation be treated as a US domestic corporation for all purposes of the code. And that means for estate tax purposes as well. So the plan doesn't work. It goes beyond triggering tax, or actually, if we have inversion, we don't even trigger tax because a transfer to a US corporation would qualify as a non-recognition. But we didn't solve the problem of estate tax. I want to jump to this slide, which sort of has the same issue of having those US stock and dealing with inversion. So what if we did the same, transferred it to a foreign corporation, but checked the box on that foreign corporation to treat it as a partnership? If we do that, yes, the partnership will be looked at as a domestic partnership. But as Stanley mentioned, we do have in our toolbox this old ruling to say, you know what, maybe it's a domestic partnership, but I don't have any rule that tells me that a domestic interest in the partnership is US situs. I do have this ruling that says if it was engaged in a US trade or business, it would be. But owning stock in a corporation is not considered to be engaged in a US trade or business. So that is something that can maybe solve this bad fact pattern, right? This is not something I would recommend as front end, come in and let's plan for this, but certainly trying to clean up the mess, it's possible. This is something to remember. Going back to these slides, using foreign corporation is definitely a good blocker from a state tax perspective, but we have to remember, is it done after we've owned the property? Because then we trigger FIRPTA tax, the income tax on the transfer. That's one thing to think about, although maybe there wasn't any appreciation. Maybe they remembered to speak to someone a week after they bought in, so no appreciation. They're not worried about FIRPTA. But I would be worried not only about the fact that there might be branch profits tax and sort of inefficiencies in this, but if I have a US child that is going to inherit this, that's not great either. I have the step up at the wrong asset, right? They're going to inherit the stock, not the property. B, that foreign corporation will be a CFC, controlled foreign corporation, which will tax at a higher rate the sale of the property. So that might not be the best scenario, depending again on the facts and circumstances. We do have something called 897I, which is an election under FIRPTA rules that only applies for FIRPTA rules. So the good thing is that if you are eligible to get it, and it's not necessarily easy because you need the foreign company to be in a country that has a treaty, and you have to have the foreign company eligible for treaty benefits. So I spoke once to an Israeli client who told me that they don't want to do anything in Israel. So Israel wasn't even an option, but then the question was, well, if we introduce a Cyprus company, will your Cyprus company be eligible for treaty benefits or not? That's a separate question to think about. If you do have the ability to do that election, then it does solve the problem, unlike our inversion issue before, because now it is only for purposes of FIRPTA. So it will still be treated. And I'm sorry, I don't think I said what the election is. The election is to treat it as a domestic company. So the election means that I can transfer the real property interest to my foreign company without triggering tax, because I have a carryover basis, and the disposition of the company is now going to be treated as a disposition of a US real property holding company, which is subject to FIRPTA. Therefore, I can do the transfer tax free, and I still was able to save the day in the sense of estate tax exposure, still a CFC, but again, many foreign children here might not plan to stay here forever, so it's not necessarily a deterrent. I think we're out of time. We do have more examples here. You can read through. Happy to answer any questions if you have after the presentation.
Great, thank you so much. We had a few requests for handouts. Handouts are all sent out before the program. They'll be sent out again after the program so everyone can see the presentation. Thank you again to Stanley and Galia. If anyone has any specific questions, new business opportunities, or any other issues they'd like to discuss, please feel free to reach out directly to the speakers or myself where appropriate, and I'll be sure to include their contact information in the follow-up email to this program. As I mentioned at the onset, the goal of these programs is to stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. Two more quick items before I let you go. First, my next program will be on May 20th and is entitled Works of Art in Your Estate Plan, featuring Andrew Katzenberg of counsel at DLA Piper, based in Baltimore, Maryland. You will receive an invitation to this webinar and all of my upcoming sessions in the coming days, and I hope you can attend. Second, be sure to take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees. I thank you in advance for that. And with that, this concludes today's session. Please stay safe and healthy. Have a wonderful day, everybody.